This week, we are exploring a really high-stakes, fast-moving financial saga.
Oh, absolutely.
It's the sudden shift in trade relations between the United States and Switzerland.
Right.
We went from a punishing sort of near-trade war environment
Right.
to a historic, new economic framework,
Yeah.
almost overnight.
And that speed, that's really the story here.
Yeah,
And the cost of that reversal, well, it kind of redefines the whole thing, this framework agreement. And you have to include Liechtenstein here, too.
right. They're part of it.
It's a deep dive into modern economic diplomacy. We really need to analyze the immense financial relief it offers, but also, and this is the key part, the massive price tag that came with it.
And the headline stat that just grabs you
Mhm.
is staggering. The U.S. cut its import tariffs on most Swiss goods from a crippling 39%
Yeah.
down to 15%.
And that 39% rate, make no mistake, it was a deliberate economic weapon. It was designed to force concessions.
Okay, so let's unpack the crisis that made this deal so necessary. For context, before all this started, the average U.S. tariff on Swiss goods was tiny.
Minuscule, about 0.6%.
Right, then, boom. August 2025, the U.S. suddenly applies this 39% tariff on, well, pretty much everything coming from Switzerland.
It was the highest tariff rate the U.S. had applied to any developed economy, and it immediately hit, something like 40% of Switzerland's total exports to the U.S., a huge chunk.
So what was the official U.S. rationale?
Well, it was focused squarely on the numbers, on that trade imbalance.
The reciprocal fair and balanced trade line.
Exactly. They cited the U.S. goods trade deficit with Switzerland, which was, $38.5 billion in 2024. The strategy was clear: inflict maximum pain to close that gap.
And that pain, it wasn't theoretical.
Oh, not at all. It was instantaneous. It was profound. When you hit an export-driven economy that hard, the reaction is not delayed. Swiss GDP. It actually contracted by 0.5% in the third quarter of 2025. And economists pointed directly to the tariff shock, the immediate slowdown in chemicals, pharmaceuticals. That was the root cause.
You can see the panic most clearly in certain sectors like luxury goods.
That's for sure.
The U.S. is the single biggest market for Swiss watches.
Mm-hmm.
So after the tariffs hit, those exports they plummeted over 50% in September alone.
Just imagine that. The inventory just piling up, market confidence just collapsing.
It's a disaster.
And it wasn't just luxury either. Across all of Swiss industry, exports to the U.S. fell 14% in just 3 months.
So this isn't just a line item on a balance sheet.
No. This was an existential threat, especially for smaller, specialized manufacturers who suddenly just couldn't afford to service their biggest market. This urgency, this is what explains the speed of the reversal.
The pressure was clearly just unbearable.
Yeah.
So how did they manage to pull the emergency brakes so fast?
By hammering out this new framework agreement on reciprocal, fair, and balanced trade.
Yeah.
And the crucial part, the immediate relief, was the U.S. commitment to slash that tariff rate down to 15%.
Now, that 50% figure, that's very significant, right? Why that number?
It's all about competitive parity. It immediately puts Switzerland back on equal footing with the rest of Europe.
You mean the European Union and...
The EU and the European Free Trade Area, or EFTA states, so countries like Norway, Iceland.
Right.
Their exporters were operating with a 15% tariff, while Switzerland was just drowning at 39%. So this new rate, it's still way higher than the old normal, but it's now, competitively viable.
And crucially, this is a framework. It's meant to stabilize things right away, even though the final negotiations are set for early 2026.
Exactly. And Swiss officials said those new lower tariffs could come into force incredibly fast, like within 2 weeks of the announcement.
That turnaround time just screams desperation, doesn't it? To get back to some kind of market stability.
It really does. And we should probably touch on Liechtenstein here for a second.
Ah, yes. They were involved, too, because of their customs union with Switzerland.
Right, but they got different treatment, which is interesting. They were only hit with the 15% rate when Switzerland was still stuck at that crippling 39%.
That seems like a pretty smart diplomatic play. How did they manage that?
It probably came down to pre-existing arrangements. Liechtenstein is part of the European Economic Area, which Switzerland is not.
Okay.
And they already had this strategic and economic partnership dialogue with the U.S. Those structures likely gave them a bit of leverage, let them be seen as a more cooperative partner.
So that brings us to the real core of this deep dive. You don't get that kind of relief from an economic war without giving up something monumental in return.
Not at all.
So if the U.S. goal was to fix a trade deficit, why is the main concession not about tariffs from the Swiss side, but about investment?
This is the paradigm shift. This is what you need to watch. The centerpiece of this framework is a commitment from Swiss and Liechtenstein companies to invest at least $200 billion into the United States by the end of 2028.
Wait, 200 billion, that's not just a colossal amount. It sounds like the non-negotiable price of admission to get back to tariff parity.
It really does, and it's not some vague promise. They specified that at least $67 billion that has to happen in 2026 alone.
So that's the down payment.
That's the down payment. And these are specific investments from corporate titans. Roche, Novartis, ABB, Stadler, they're targeting high-value sectors.
Like pharma, aerospace.
Pharmaceuticals, medical devices, aerospace, yes. Even gold manufacturing, energy infrastructure. And the White House is making a huge deal about creating jobs across all 50 states.
It really sounds like the U.S. leveraged this tariff crisis to force massive, immediate manufacturing growth at home.
That is precisely the read on this deal. And Liechtenstein, though it's a smaller economy, they committed to at least $300 million in investment and to boosting U.S. jobs from its companies by 50%.
So it's all structured around domestic U.S. goals.
Completely.
Okay, so beyond that huge investment number, the U.S. also got better market access. What kind of doors are opening for American goods?
Switzerland and Liechtenstein are intending to remove their own tariffs on a whole range of U.S. goods, industrial and agricultural.
So things like?
Think specialty foods, fresh and dried nuts, fish, seafood, also chemicals, and this is an important one, spirits like whiskey and rum.
So American bourbon's going to have a much smoother time getting into Swiss bars.
That's the intention, yes.
Oh.
Plus, the U.S. got new tariff rate quotas, specifically for American poultry, beef, and bison, but, you know, it goes beyond the simple tariffs.
You mean those invisible trade barriers, the non-tariff stuff?
Exactly, the regulatory hurdles.
Can you give an example?
Sure. Switzerland committed to streamlining requirements for U.S. dairy and addressing some restrictive measures on U.S. poultry. A big one for U.S. auto manufacturers was Switzerland agreeing to recognize U.S. federal motor vehicle safety standards.
That's a huge streamlining gain.
A massive gain.
Okay, let's pivot back to the relief this brings. For the watch industry, that 15% cut is a lifeline.
A breath of fresh air.
But what about the really big one, the pharma and chemical sector? That's the engine driving that huge trade deficit in the first place.
For pharma, the 15% rate is just. It's critical stability. It acts as a ceiling. It rules out the risk of much higher sector-specific duties that could have been imposed under U.S. trade law.
You're talking about things like Section 232 duties, the national security ones.
Exactly. Those can go up to 50, even 100% on specific imports like patented drugs. By guaranteeing a 15% cap, the framework removes that existential threat. And that provides the corporate certainty for companies like Novartis and Roche to actually follow through on these massive pledges to build new manufacturing plants in the U.S.
So the stability is directly tied to the investment promise. It's all connected.
It is.
But we have to address the reservations. This is a framework. It's not a done deal. The Swiss press has been raising some pretty critical questions.
And they should be. The main concern is about how concrete this all is. One professor pointed out that the White House text, the one outlining the framework, it uses the word intention 46 times.
46 times.
46, which tells you that while the political will is there, the hard work of turning these wishes into a legally binding agreement, that's just beginning.
That sounds incredibly soft for the U.S. to be relying on, especially when the main concession is that $200 billion investment, which is based on corporate intentions. What happens if the companies just change their minds?
That's the crucial political risk here. The
Yeah.
Swiss government, Bourbon, it can't formally force its private companies to spend their cash overseas. It's voluntary.
So the whole thing rests on incentives.
It rests entirely on the powerful incentive of tariff relief and market access. And, you know, the political pressure from the Swiss government to make good on the promises that restored that stability in the first place.
So the U.S. leveraged a crisis to get a massive domestic investment that the Swiss government can't even technically guarantee. That's pretty shrewd negotiating.
Very shrewd.
And what about the other elements, like cooperation on sanctions?
The framework does explicitly bolster cooperation there. That's a key U.S. objective. But the Swiss economics minister has been very careful to provide political cover back home.
What did she say?
He stated very clearly that Switzerland keeps its independent decision-making, that it is under no obligation to automatically adopt U.S. sanctions. It's a very delicate balancing act.
So when you boil it all down, what's the ultimate takeaway for the listener from this whole drama?
The deal provides fundamental stability. You can already see it in the economic forecasts for Switzerland. The 2026 GDP growth forecast has been raised simply because the tariff hit is so much smaller.
So Swiss industry is back on a level playing field with its neighbors.
Yes, they can compete on the same terms as their European rivals. And that stability was desperately, desperately needed.
And that leads us to the final provocative thought we kind of hinted at earlier. For a country like Switzerland, their industrial tariffs were already gone, abolished back in 2024.
Right, they had nothing left to give on that front.
So they had almost no traditional tariff concessions to offer the U.S. The solution was this colossal $200 billion commitment. So the question for you to think about is this. Does this episode signal a definitive shift? A new global precedent where massive foreign investment, not tariff cuts, is now the main currency for achieving trade parity with the United States. It certainly suggests the price of market access for wealthy nations has just been redefined.